Hello traders, Greg here with a market update. Okay, so overnight in the US we had some very important top tier economic data out, and that was the US inflation CPI data for April. Previous month for the headline inflation number, for the CPI number, year on year, that came out, that spiked up to 3.3%. Market was expecting this April number to come out a touch higher, around about 3.6, maybe up to 3.7%. But it actually came out even higher, came out at 3.8%, so well above expectations and pushing towards 4%. So it looks as if inflation is starting to filter back into the US on the back of what is happening with crude oil. Now, the core number year on year, the core number actually excludes food and energy, so that crude price isn't included. Previous month, that was at 2.6% year on year. Market was expecting that to marginally go up to 2.7%. But the core number, just like the headline number, also went up, and that went up to 2.8%, so above expectations and pushing 3%. So look, these numbers obviously aren't good numbers. So there is inflation is starting to hot up again in the US. So if you look at the Fed funds rate at the moment, it's at 3.5%. So look, the headline number is certainly above Fed funds, but the core number still touch below 3%, is below Fed funds. So market at the moment isn't yet getting worried about Fed rate hikes, and still thinks that the Fed's pretty much going to be on hold for the rest of the year. But I'd suggest that if we continue to see in the months ahead that core number edging up towards Fed funds and headline going well above 4%, I think it's inevitable at some stage. The risk is that market is going to, and the Fed's going to be forced to hike rates at some stage, maybe possibly around that September meeting. So anyway, that is a risk going forward for the market. Okay, so how did the bond market react to this? So we did see US 2-year yields and 10-year yields up about 1%. So 2-year yields now are pretty much at 4%. So it's the highest that they've been for some time. Pre-war they were actually down, down towards 3.4, below 3.5%. So they've come a long way higher. The 10 years, they are now back above 4.4%, around about 4.3%, and they are pushing up towards a very critical level, which is 4.5%. That is a level that's a bit of a line in the sand. And it's a level that we saw Trump backflip on reciprocal tariffs last year, to get those yields lower, which he was successful in doing. But here we are, we're back up there and breaking 4.5%. There is a possibility, obviously, that the market is going to want to push up towards potentially 5%. None of that is good. Technically as well, we've been trading in a huge triangle formation, those US 10-year yields for the last 2 years. And we are technically at the moment right up against that trendline resistance. So even technically, we go up towards 4.5. It looks like we'll be breaking that chart formation, and that chart formation does want a lot higher for yields. So certainly, trading these markets at the moment, I think you need to keep an eye on what's happening with these yields, especially if they start to break higher, because obviously it's going to impact pretty much every other market, and pretty much in a negative way. Because obviously we're going to see a stronger US dollar. It's going to weigh on precious metals, especially gold, and it is a negative when yields go higher for equities as well. Tonight we do have another economic data print out of the US, which is important for yields, and that is producer price index. And market last month that spiked up to 4%. Market is expecting that to go up a whopping 1%, or around up to 4.95% almost. So it's a huge rise in PPI. This is inflation at the producer level. Generally, when that happens, it gets fed to consumers at some stage with a bit of a lag. So seeing a hot PPI straight after a hot CPI is something that could get this yield spiking higher. So again, something to watch out for tonight and a big focus for the market. Looking across other markets, US equity markets, absolutely phenomenal performance. US equity markets did get hit on the back of that hot inflation number, but on the close, what did we see? We saw a pretty big reversal. The Dow actually finished up marginally positive, 0.1%. S&P marginally negative, just 0.1%. And the only one that really lost any ground was NASDAQ, and it was down 0.8%. But still, all of those equity indexes well off their lows, and it's just the absolute this bull run, raging bull market that we're seeing at the moment in equities. It just shrugs off any bad news, whether it's the war, whether or not it is crude oil prices, whether or not it's yields, hot inflation. Investors and traders are just continually buying dips and just will not sell. Having said that, again, at some stage, if the yields do some work and start breaking higher, I can't see these equities hanging on. Again, for equity traders, certainly keep an eye on those yields. As far as the currency markets are concerned, yes, they did exactly what they're supposed to do when you see high yields. US dollar was bid. So we saw dollar index DXY up just over 0.5%, whatnot. Dollar yen was one of the biggest movers. That went up at like a big figure yesterday, back up to 157, 60, 70 level, pushing back up towards 158. The lows from the Japanese intervention in the last week or so was just sub 155. So dollar yen is now going back almost 300 points from the intervention lows higher. So I'd imagine the Japanese are looking at this, shaking their heads in that they cannot get the yen strengthened even with intervention. It's almost like giving the market free money. So I'd imagine they're going to have to raise rates next month to really get some traction on the yen. But in any case, dollar yen, yes, higher. Precious metals, gold had a bearish outside range day yesterday. It doesn't like yields high, it doesn't like US dollar higher. And it's hard to see those precious metals, especially gold, getting any traction when we're seeing what's happening in yields. So I'd certainly be looking to bias selling any sort of strength for lower levels to come. Crude oil's trading over $100. Obviously, we're getting no positive headlines with what's happening in the US and the Middle East. So that is an issue. And if crude does start going towards $110, you'd imagine that's going to weigh on equity markets. It really needs positive headlines to go lower. They don't seem like they're coming anytime soon. Anyway, finally, Trump lands in China soon, so he's there for a couple of days, lots of high-level meetings, obviously. We're going to get lots of headlines. So look, a lot going on in markets. Good luck. We'll check back with you shortly.